Again, thank you for joining us for today's webinar, USDA Section 538 Guaranteed Program, Part 1, Understanding Program Impacts on Affordable Housing Projects. I'd like to welcome and introduce today's speakers, Edgar Morales of USDA Rural Development and Philip Porter from Enterprise Community Investment. Edgar Morales serves as part of the headquarters team in the Multifamily Guarantee Loan Division at USDA Rural Development. He previously served as California's Program Coordinator and Underwriter for Rural Development Section 538 Guarantee Program, where he was directly responsible for growing California's Guaranteed Loan Program into the #1 program nationwide. Philip Porter is the Vice President for Syndication at Enterprise Community Investment. Since joining Enterprise in 2001, Philip has managed the investment of over $1.9 billion of low-income housing and historic tax credit equity in 270 developments with over 18,500 homes. But before turning the webinar over to Edgar and Philip, I'd like to introduce and welcome Joel Baxley, who is the current Administrator of USDA Rural Development's Rural Housing Service. He comes to USDA Rural Development with 24 years of real estate finance and development experience, including 13 years providing valuations of complex property types, as well as strategic investment analysis for commercial real estate as an asset class. Mr. Baxley, if you would please. Thank you.
Thank you, Shantaria. Good afternoon, everyone. I'd like to start by thanking the Housing Assistance Council, the Enterprise Community, and all the other program partners for arranging and participating in these two webinars. Today, the focus of the webinars will be the Section 538 Guaranteed Rural Rental Housing Program and how it can be used as a critical financing tool in today's affordable housing market. The Section 538 program will be critical, as I said, going forward in affordable housing, as it provides a debt financing for reservation and new construction when those funds are getting limited more by the day. The Section 538 is important that it provides financing flexibility, especially when tax credit dollars are involved. And as we all know, those tax credit dollars are being stretched as increasing costs for building and acquiring land for affordable housing. In fiscal year 2018, the appropriation for the 538 program is $230 million. Year to date, 95 million of those commitments have enabled 67 transactions to be completed without relying on additional taxpayer funding. As in recent years, a significant portion of the funding supports preservation, and that is going to be a big focus of the 538 program going forward, and Edgar will talk a little bit more about that in just a few minutes. To advance the preservation effort, we've established a website that lists all of our properties with their mortgage maturity dates and other details that you'll see on your slide in front of you. We urge you to reach out to that website and click on there and see if there's property that you may be able to help with or know someone that would be interested in helping us preserve going forward. The guaranteed loans provide gap financing to meet critical rehab needs of older properties, and we certainly don't want the program to stand still, and we look for opportunities to improve it. A few items of note: Rural Development published its first multi-year NOSA on December 21st, 2017, which remains open until December 31st, 2021. This NOSA avoids timing issues and funding gaps associated with annual NOSAs, and the agency can now continuously accept and process applications. Additionally, ultimately, the goal is to eliminate the need for NOSAs, and we are working on that. For the past 2 years, the agency has approved modifications to lower the interest rates on existing 538 loan guarantees. As a result, our borrowers have saved on average more than $14,000 a year in payments. We look to you as partners to help us continue this improvement and fulfill Secretary Perdue's goal of working efficiently, effectively, with integrity and customer focus. Section 538 needs to remain competitive in the market, and we hope that you'll help us meet that goal. Positive feedback from the field and market participants and market partners such as yourself have expressed the need for competitive market terms and conditions, more efficient delivery of the program, and other ideas. RD is reviewing ways to improve the delivery of the program, improve the program's terms and conditions, and other ways to continually improve the program. I would encourage everyone to join our quarterly industry forums to discuss issues, current events, program funding, etc. These teleconference calls provide an open forum for stakeholders to discuss issues regarding the program, and we welcome any ideas you might have. Please stay in touch with everything that is happening in the programs and provide us your email address with the link listed on this slide. And we will send you the program updates and alerts on all program developments through our government deliverable portal. Please enjoy today's webinars, and I trust that you all will get something great out of it and help us push forward the 538 program and making it more effective in preserving affordable housing. Thank you.
Thank you, Mr. Baxley. Edgar?
Sure. Thank you. So let's get into it. Again, my name is Edgar Morales, and really the purpose of today is going to be more of we're going to give you a snapshot of the 538. The webinars have been broken down in part 1 and part 2. We hope to spend a little bit more of a deep dive in part 2 because we've got just a short period of time in today's presentation. What we'd like to do is give you an overview of the program, kind of the nuts and bolts of the program, some historical perspective, and take some questions that at least for some of you might be revisiting the program, and for some of you may be looking at the program for the very first time. So again, we really thank all of you for participating today, and we hope that you're going to be able to get something that you walk away with. As you know, USDA is a big agency. We do a lot of things, in rural communities. Our mission of housing and feeding everyone, one of the main focuses and what we're talking about today is providing safe, decent, and sanitary, affordable housing. This is not accomplished alone by USDA, and that's really where our partnerships come in. And that is something, as Joel shared and as Shantaria shared earlier, partnership is really how we are able to leverage these programs and deliver these programs in the communities that we serve. The partnership with HAC has been an ongoing. HAC has always provided a lot of training on the USDA programs. They keep our communities abreast of the changes of what's going on. HAC has allowed us a platform to educate the community and revisit the 538 program, along with many of our programs. And so we appreciate that, through collaboration, like I said, is really the way that we deliver these programs. This is not something that's done by USDA alone. The 538, when many folks look at the 538, there is a clear distinction in multifamily. When those of you who have been around USDA for a long time, when you think multifamily, sometimes you mesh or you think all programs are equal. And some of you, know all of the different programs that we carry. But the clear distinction between the 538 and the flagship or the early days, which was the 515 program, is that the 538 is not a direct loan from the government. And so unlike the 515 is a direct loan. We have more control over the underwriting and how that loan is processed. The Section 538 is a guarantee loan that is really lender driven, and those loans are made directly to developers from participating lenders. So kind of to put the program in perspective is really to go back and see where did the 538 start. For many of us that are not familiar with the program, we may think it is a new program, and it may appear that it is a new program, but really the Section 538 was part of the original Housing Act in 1949, along with the other programs that were authorized, such as the Section 515, 514, our farm labor programs. And so even though it was authorized back in 1949, we really didn't start, getting our hands around the program until the late 1990s on that. Up until, the year 2005, there was really only a handful of loans that were made, just because nobody, at that period of time, we still had plenty of subsidy. The 515 program was fully funded. And therefore many developers were going for the deeply subsidized programs. And so at that time, the Section 538 carried interest credit, but it wasn't quite the deep subsidy that was being provided with the 515 loan. Prior to 2009, the Section 538 provided interest rate subsidy of up to 250 basis points on the loan. And at that time, we were actually tied to the applicable federal rate. So, even though we provided interest credit subsidy on the program, we did have some restrictions as to the type of programs and sources that we could mesh, the Section 538 with due to the restrictions that were tied to the applicable federal rate. In 2009 was the first time that the 538 was actually looked at and used for the preservation of our first 4 515 transactions. I mean, we're talking just 10 years ago, and so 10 years ago is when we started using the Section 538 guarantee loan in conjunction with the 515 transfers, acquisition, rehabs. That same year, the program lost its identity of the interest credit. For many, the loss of the interest credit, some of them thought that the program was going to go away. And really there's a lot of things that happened in 2009. In 2009 was kind of like a perfect storm. In 2009 was really, it was post the housing crash, and we had the loss of sources that were available in the way of soft monies. Many states lost their redevelopment agencies. So there was limited sources of funding that were available. And so many developers and many lenders started to take a look at the Section 538 again. And so at that period of time is when we started to gain momentum, because the Section 538 is the least restrictive of most of the RD programs when it comes to underwriting, especially when we're dealing with loans that can be meshed with other sources of funds that might be far more restricted than the Section 538. In 2000, between the period of time after that up through 2015, we had a steady stream of business when it came to the guarantees. We probably had a handful of lenders, that were doing the program, working with many of our nonprofit groups, with some for-profit developers. Right around the 2015, we started to pick up a little more momentum on the for-profit developers, and they started to see the ability to use the program to build, farm worker housing and to build affordable and workforce housing. In 2016, we hit the milestone of $1 billion in closed loans. Now, to many that may not, in the world of affordable housing, that may not sound like a major milestone when it comes to affordable lending. But when you look at the period of time that we covered, really we're talking about that period of time from, post-2006, really a 10-year window, we were able to close $1 billion in loans when loans were averaging about 1.5 million. We don't have any loan sizes or loan limitations, but at that time we were basically being used as gap financing. In 2017, we obligated over $188 million in the program. So availability of funding, that's really, when folks look at the program, historically most of federal programs run off of the NOSA and a NOFA. And, there was a challenge with the start-stop lining up applications to mirror the time frame of a tax credit application. There was times where we didn't have a NOFA in the early years, or it came out too late, and it was really tough to match that up. One of the things we've been working on, as you heard Joel talk about process improvements and program improvements, is to try to do away with the NOFA process altogether on the guaranteed loan program. And one of the things that we were able to accomplish under the last NOSA was we were able to get a NOSA published for 4 years. So our current NOSA is open through 2021. And so that really allows you as a developer to better align your applications with whichever state you're working in, the tax credit cycle or other sources of funds that you're going to be working on. So it pretty much makes us over the counter. Historically, the program has received an annual authority of about $150 million. As I stated, in 2017 we obligated just a little over $188 million. The program is budget neutral, so we talked about that it's no cost to the taxpayer. We currently have authority of $230 million in the program right now. We probably will get something pretty close to that in the fiscal year 2019. The program is lender-driven. So again, you know, there's a clear distinction. This is not a loan that is a direct loan from the government. This is a guaranteed loan, and we rely on our approved lenders to deliver the program. At a quick glance, as we stated, the program is driven by approved lenders that participate in the program. We service eligible rural areas up to 35,000 in population that are not, you know, butting up next to an MSA. In the earlier slides, you saw an eligibility link. That link will tell you whether the project is eligible or not. You can just go into that link, put in an address, it'll populate an eligibility. It'll tell you whether the project is eligible or not eligible. And if you have any issues with that, you can always reach out to us and we can assist you with that. The program itself does not have any loan limits, so we don't have a minimum loan or a maximum loan. We've done loans as low as $250,000, and we've done loans as high as $21 million on the permanent side. And so, again, you know, we're not limited or constrained by any guidelines on loan limitations. For acquisition rehab, when we're talking about rehab, in order to qualify to get into the program under our acquisition rehab, you need to have a minimum of $6,500 per door in rehab. So that's really, and that's not much when you're looking at, most of our rehabs are anywhere from $30,000 to $60,000 per door. They're either gut rehabs or major rehabs on that. The guarantee can be used to enhance tax-exempt bonds. As far as fees, currently there are no application fees under this 4-year NOSA that was published. There is a 1% guarantee fee that is charged at the closing, and then there's 50 basis points that is charged on an annual basis on top of the principal. So if you've got your rate of whatever your rate is, you add those 50 basis points to your rate, and that's what your monthly debt service payment is going to be. Lender fees, that we do not get into negotiating lender fees. Lender fees are negotiated between the borrower and the lender. And so the pricing, like I stated, is no longer tied to the applicable federal rate. That is market driven. And so there's very competitive rates in the program. The program does not require that you use tax credits as part of the financing structure, although over 95% of our projects have tax credits. As I stated, you know, when we're looking at the impacts of what the program allows, nearly all of our 538 loans have been in conjunction with 9% tax credits and 4% tax-exempt bonds. You know, well over half of our projects have secondary debt. The program does allow for hard seconds. It does allow for soft seconds. So, you know, it's one of the least restrictive programs in the affordable housing finance world. Mixed income, with some of the new changes, and Philip will be getting into some of this, so I'm just gonna point this out, but the project can be underwritten with mixed income, so we can use income averaging, which is a little bit different than some of our other programs. It is compatible with opportunity zones, equity, and you can underwrite these projects for workforce housing. We do allow for rents to go up to 115% of area median income. So we're kind of the big umbrella. And so if you have more restrictive funds in the deal, the lender's going to underwrite to the most restrictive rents. But for our purposes, our big umbrella is no more than 30% of 115% of area median income. So that pretty much, in some markets, that's pretty close to market rate. Program works well with Section 8 HAP contracts. If you're going in acquiring a new project and it already has a HAP contract, maybe awarded from a housing authority, the program underwrites well with that, or with RD assistance if that is available on the 515 projects. or any other type of subsidy that is allowed on the project. Benefits to developers, the loans can be used for either or, the acquisition rehab or for new construction. For acquisition rehab, the project does not have to be an RD asset to begin with. So if you're acquiring another affordable project, that could be either an FHA project, or it could be just another project that has a LURA or a restrictive use that's an affordable project. You can acquire that with a Section 538 loan on that. The benefit of the Section 538 is number one, is as you can see, you can go up to a 40-year amortization. So, you can do any combination. We have to have a minimum term of 25 years. So 25 years is a fixed rate term. You can do a combination of 25 to 40, 30, 30, 30, 40, whichever you like, but you can go up to a 40-year amortization. So what that allows you to do is to be able to bring in more loan proceeds that will be available for more development or for more rehab without necessarily increasing the debt service to the project. The loan itself does not kick in Davis-Bacon wages. Now, if you're using other sources of funds that require Davis-Bacon wages, then you need to, like I said, you need to underwrite to the most restrictive of those uses. But as a standalone, on a 538 loan, we do not trigger Davis-Bacon wages as part of our program on that. CRA credit, that is available, for lenders that may be of some importance. Some of our CRA areas, our loans do qualify for lenders that are interested for CRA credit. When we're looking at 538 and we're comparing it to the other market, to other market financing that is available, we don't compete with lenders, and that's really the neat feature about the Section 538, is that we are basically, the guarantee adds value to what the lender is already doing. If the lender has the capacity to take on a 25-year fixed rate with a 40-year amortization, we can guarantee that financing. You can use one of our approved lenders already, or if you currently have a relationship with a lender that you're working with, we can work with that new lender. The lender is allowed to submit an approval package at the same time they submit their first application. And so there's a quick cheat sheet and a quick checklist that they can determine whether, to kind of do a pre-qualification to see if they're going to be able to become an eligible lender. Most of our loans are sold in the secondary market, though. There are some lending entities that do portfolio the loans. They keep the loans on their balance sheet. Some HFAs. We do have HFAs that participate as lenders, and we have other lending entities other than just banks that participate. Most of these loans, though, are sold in Ginnie Mae pools. They either go Ginnie Mae or they go Fannie Mae, but that enables the lenders to offer premium pricing to their borrowers and transfer those savings to the project and the development. Again, I stated that LIHTCs are not required, but like I said, most of our projects do have low-income housing tax credits because in order for us to offer affordable financing, we have to have a low loan to cost in order for us to be able to keep those rents affordable. Now, if you're not using low-income housing tax credits, though, and you have other forms of equity, the project also works well for workforce housing. Workforce housing seems to be a great need that just in the last 18 to 24 months, more and more housing advocates are taking a look at this and trying to see how they can bring more workforce housing in addition to the low to very low to address that 50 to 90% of area median income. This program works well with that. As I stated earlier, the program allows us to go up to 115% of area median income on that, and again allows you up to a 40-year amortization. So what's new in the program? Those of you familiar with the program, the newest things, and Joel mentioned that earlier, is that the program offers a rate modification. So if you've got an existing 538 or an older 538, and you're not looking to recast the number of years on the loan, you can, and lower interest rates are available, you can do a rate modification on the project loan. You can also do a refinance of the existing guarantee loan. Now that's a great tool for many project owners that maybe do not want to resyndicate with maybe new tax credits, and they've been able to build some equity in the project, and they've got a 40-year loan on it, but maybe they want to do some minor repairs, they want to refinance it, take some cash out, but not put new tax credits on it and recast it out to another 40 years. The program allows you to do that. So that's a neat feature. Those features have been added to the program just in the last 18 months. So what's the process? So, you're interested in applying for a Section 538 as part of your project loan and part of your development. These loans are submitted through an approved lender. So the lender is going to develop the application for you, and they're going to submit it to the RD state office in whichever state that you're working in. And so all of the communication goes through the RD office. And typically what happens is you need to submit a response to the NOSA, which is currently open. At that point, the RD office will process that response anywhere from 2 to 4 weeks. They will issue a notice to proceed, which is an invitation for the lender to submit a full application. And a full application means it includes an environmental. When I make emphasis on environmental, because the environmental is a critical piece, we can't issue a conditional commitment without the environmental. So if you're dealing with new construction, I encourage you to get us involved early. Even if you're not ready to submit the full application, have your lender engage with the local RD office and start working on the environmental piece so that we can make sure that those environmental conditions are taken care of prior to issuing the conditional commitment. Once you get a full application submitted, the application, most likely, depending on the workload of the RD office, they can normally get those out between 60 to 90 days, and sometimes less. What I encourage folks to do is always check with the state office, get a commitment on timeline on what to expect. I also encourage all of you to set up a concept discussion. Get everybody on the phone so you can start working from your timeline, from your closing backwards on that there. So quick summary. The loan is not a direct loan. So the Section 538 is not a direct loan from the government. It is a guaranteed loan by the government. The program is lender driven. We do not have loan limits on the program. The loan, the Section 538, can be used for new construction and rehab. Funding is readily available, pretty much over the counter. There is no tenant recertification required. Now, if you have tax credits in the deal, you may be required to recertify for tax credit purposes. But RD does not require recertification of tenants like we do on our 515s. Okay? The initial occupancy, as I stated earlier, would need to be no more than 115%. Rents cannot be no more than 115% of area median income. Eligible rural areas with populations of up to 35,000 or less on that. I know this was really quick, and like I said, this was a snapshot. We're going to get into a little bit more detail next week, and hopefully, most of you can make it there. At this point, I'd like to quickly open it up for a couple of questions if we have them, and if not, we can move the rest of the questions after Philip Porter goes into his presentation.
Thank you, Edgar.
Do we have? Yeah.
Thank you, Edgar. Looking at it right now, and got a question from Joel Smith out in Colorado. Wants to know, can you go over the collateral requirements briefly?
The collateral requirements, like specific, that's kind of a general question. as far as the collateral requirements, I'm not sure exactly what he's asking on that. If I can encourage you to email me, I can email you exactly what those details are specific to your question. I mean, as far as collateral, we you know, the obvious is the real estate part, you know, so I'm not sure exactly what your question is.
He sent a follow-up. He says, will leasehold interest on trust land be acceptable?
Like tribal land?
Yes.
Yes. But, and I say that we need to look at what exactly. If we're talking about tribal land, the answer is yes. But I would encourage you to email me so that I can get you specifics as to what we can and cannot do. We do lend on tribal land.
Thank you.
Okay.
Looks like that's the only question. I
Okay.
want to give folks maybe a few more seconds to kind of type their questions in if they're doing that. But if not, then let's see, give it another few seconds. Any additional questions for Edgar? All right, I say we proceed on with Philip, please. Thank you.
All right. All right, Philip.
Well, thank you, Edgar. I appreciate the opportunity to share my perspective on the tax credit market and how the tax credit program is working with the RD 538 loan program. So let me hit some high points. Some of this will be, again, review for many of you. Others, this may be useful historical context. So just taking us back to the beginning, with the tax credit program, it was created by the Tax Reform Act of 1986 under the Reagan administration. So this was a Republican effort, quite a long time ago now, that emphasized public-private partnerships and has garnered a lot of bipartisan support over the years. But this program is not a HUD program. It is administered by the IRS under Section 42 of the Internal Revenue Code. The program has resulted in building or renovating over 2.8 million homes across America. So it's accounting for something like 90% of the housing production. It's the longest running federal housing program that we've had in this country, and it's become very refined and functional over time. The result is capital subsidy for the developments ranging from 25 to 80% of the cost. The market for investing in these developments to benefit from the tax credits and the other tax benefits associated with investing are typically banks, but some insurance companies also participate in this market. And what the banks particularly are after is regulatory credit under the Community Reinvestment Act. They also seek real return, just as do the insurance companies. Typical returns, just for context, are sometimes below 4% after tax, even now, and all the way up to about 6% after tax to the investor. So these returns are still relatively low in historic context today. But the market shifted dramatically with the presidential election in 2016 because investor expectations about the future of tax policy and the concerns around tax reform caused folks to reprice the investments. So prices immediately after the election adjusted downward, assuming tax rates of 20 to 25%. And that carried on through 2017, resulting in 8 to 20 cents per credit less investment in the deals. That, of course, had a huge shock on the system, and many folks were saying, hey, the tax rates haven't changed. Why are prices coming down? And it has to do with, again, the expectations, because everyone's going to be holding these investments for at least 15 years, but also what is less valuable. Primarily, what's reduced, the reduced value comes from lower tax rates mean that the write-off of the capital account of the investor is worth less to them over time. So the losses are worth less than they had been historically. Right, moving forward a little more, the first real devaluation of the investment value with the tax credits occurred with the Tax Cuts and Jobs Act signed in December 22nd of 2017. So that was after a year of everybody speculating and kind of betting on where tax reform would end up. We got a result. And that was a clear result. Corporate tax rates dropped from 35% to 21%. 40-year depreciation is no longer available. Rather, 30 years is the maximum depreciation that we can take on these housing investments. And where we used to have 27.5-year depreciation for certain deals, the conditions for using 27.5-year depreciation now are pretty hard to satisfy. So really, in my experience, pretty much every deal is using 30-year depreciation. One of the things that was implemented with the Tax Cuts and Jobs Act was to add bonus depreciation. So that means writing off immediately the furniture, fixtures, and equipment and site improvements. Though that 100% depreciation in year one will decline over time. So by 2022, the speedy depreciation is no longer available. But that speedy depreciation should help returns. Turns out it's not always a good thing for every investor. But overall, because of the impact on pricing associated with the changing tax rules, it's understood that roughly speaking, 235,000 units over the next 10 years will not be built or renovated because of tax reform. So that's about a 14% reduction in the equity market. And that's rough for all the housers and all the folks who we serve. But it could have been worse because the private activity bonds were on the chopping block. And as I understand it, the bonds were one of the last things to be maintained, or the decision around whether to eliminate private activity bonds was one of the last things resolved as the tax reform bill went through. So that would have been a whole lot harder on the system. Let me forward now to the next slide. So challenges in the market. Comparing where we are today from 2016. Overall, the pricing today is down in the range of 83 cents up to maybe $1.02. That's a 20-cent range, which is actually very typical. You don't see it for a given deal. Usually the range of pricing that is available to a given deal is in a 2 to 4 cent window. But across the market overall, there's quite a range depending on whether the deal's a small investment or a larger one, whether it's new construction versus rehab, which new construction deals deliver their tax credits and losses later in the life of the investment relative to a rehab deal. 9% deals are typically actually sort of worth a little less than 4s because of the loss benefit ratios. And then CRA locations are just more valuable to investors. There's more demand as compared to non-CRA locations. So those are the key factors that determine where you end up in this 20-cent range. But right now, I'm seeing most 9% deals in the range of 86 to 92 cents. And that's, from Eastern Washington to Western Maryland in terms of the more rural markets. One factor in the changing demand is the base erosion and anti-abuse tax rules. This is called BEAT colloquially. And that's an issue for some banks that are owned by international companies or that have operations and earnings outside of the United States. There are some additional tax rules that may cause them to be unable to benefit fully from the tax credit. So many banks are sorting out their liability under BEAT. Losses, as I mentioned before, are less valued. Like I said, bonus depreciation is not always okay because that can have a negative impact on an investor's earnings statement, their income statement, and so that impact on earnings is something they don't want. Alternatives are more valuable as tax rates drop, and especially as interest rates rise. So traditionally, tax credit investments are compared to BBB minus bonds, and so it's really at the margin. There's more interest in higher rate debt securities at times than tax credits, given the return rates that we're delivering right now. And then also something that's not obvious, but as interest rates rise, the value of a construction loan to create positive arbitrage for a developer by bridging equity, you get a higher price that's greater than the cost of the construction loan to get out to pay in. Well, that as interest rates rise, that produces less and less value. And occasionally now, deals are just taking their money early and funding the development with equity rather than taking out a construction loan. It's just not as efficient. So as equity comes in earlier in the life of the deal, it's typically priced lower. So that's another aspect of what's going on. It's not hurting the net value, but it is resulting in a lower price per credit. And overall, this is all in the context of institutions revising their tax plans as their tax liabilities have dropped. All the credits they've bought before, need to be rescheduled, and there's just quite a bit to folks sorting out where they will be going forward. So some investors in 2017, had stepped away, just waiting to see, and so now they're stepping back up to buy some tax credits, while other investors, now that they really know the rate, are taking a little bit of a breather. So, here are some suggestions as you approach the syndication market. Given the volatility, if you have a preferred partner, I'd recommend you engage early with them, especially for renovation deals, which are typically slotted in multi-investor funds. You want to be sure that the syndicator you're working with has a fund closed that can benefit from the tax credits as soon as your deal delivers them. So that's a key factor with renovation projects. But also, there may be an opportunity to go with one of the GSE funds. GSEs are Fannie Mae and Freddie Mac. They are back in the market, and I'll get to that a little more in the next slide. Another benefit of working with your syndication partner early is just to identify whether the Fannie or Freddie funds would be available for your deal's location. They have duty to serve requirements, and those are very much place-based, and it's something that has to be referenced by street address. But overall, investors are taking longer to get to yes, where historically 2 to 3 week RFP processes were fine. Now it's much harder to identify an investor ready to go at that price on that schedule. So I'm finding if you have in your schedule 4 weeks or more to solicit equity proposals, I think that's better. A lot of times folks are eager to manage their guarantee liabilities or push other terms, and I would recommend that, to the extent that you can, just keep your deal as square as possible. Square deals get the best pricing right now, as investors are, generally speaking, more tentative. Some are pulling back. They're just less willing to give on terms. But positives. There are some positives despite prevailing winds against us. First off, for rural deals, Fannie Mae and Freddie Mac coming in, they're planning to invest about $500 million a year, and that will substantially go to rural deals. There will be some in CRA markets or in some that are free to go everywhere, but a large chunk, something like 40+%, will be in rural markets. The multi-investor funds, which were way down in 2017 as investors took a breather, wait and see what would happen, they're coming back. So for instance, Enterprise, we invested $164 million in multi-investor funds in 2017. This year we'll do about twice that. So that's a good thing for rural deals where many go. Some CRA markets are overbought on the coasts, and that's pushing bank demand into secondary and tertiary markets so that they can lever up, get some yield, a little bit more yield, and that's moderating price reductions in the rural markets. And then more recently in March, the omnibus spending bill passed, which increased the 9% credits by 12.5% over the next 4 years. That will get the industry about 28,000 more units of production over that 4 years. So that helps offset the overall loss associated with tax reform. And I'm seeing deals getting done with that increment right now. The other key piece of the spending bill for us that Edgar mentioned before is that income averaging is now a permanent option available to developers. You can charge and qualify for tax credits as high as 80% of AMI rents. The project overall has to maintain a 60% average, but you can include higher income people now. So the implementation is being sorted out state by state. The compliance issues are pretty challenging. I see this in the short run as useful if you're taking a subsidized project or a naturally occurring affordable development and running it through a syndication. It would allow you to have some folks who are above 60% of AMI income still earn the credits and not have to manage relocation for them on a permanent basis. So it will help the feasibility of those types of deals in the short run, maybe more long run. And then, in the interest of time, I'll focus on opportunity zones and leave other 538 questions to the overall Q&A session. But opportunity zones. So this is something that was part of the Tax Cuts and Jobs Act of 2017. It was kind of a surprise that it would actually be included. It had been something Enterprise had worked on for a long time, but did not expect it to move, and then it showed up. So that's a good thing, and we're actively pursuing this right now. In the final analysis, it allows for the investment of capital gains into qualified census tracts to defer or reduce future capital gains tax paid, with new long-term gains not taxed. So let me just try to clarify a couple of those terms. So the money invested in these opportunity zones do need to be from a capital gain, and that's a different source of sort of income than most banks have. It also has to be invested on a certain schedule. So to put an example with it, if you invest prior to the end of 2019, then you can get a 10% reduction in that gain that you put into the deal after 5 years, and then another 5% after 7 years. At the end of 7 years, you have to pay your capital gains tax on what you invested, less the 15% that you got to step up in basis for under this program. But any new gains, if you hold the investment after 10 years, will not be taxed. So that has been evaluated, and Novogradic's putting out a lot of analysis suggesting that might create as much as 8 cents of value for a typical tax credit deal. However, the trick really is matching investors with deals and figuring out a way to monetize the program in a timely way. And because banks, as a rule, do not have capital gains, they have, current income, right? Turns out insurance companies, life companies, are the type of organization that would have capital gains. And so that's tapping into a slightly different market than is traditionally invested in the low-income housing tax credit at scale. And so the industry as a whole is trying to figure that out right quick and match up the investors with the deals that qualify as quickly as we can to get as much value as the program promises. But it's not, I wouldn't count on it solving a major gap in your deal in the short run, but it's definitely something to keep an eye on. So I'd like to conclude my comments there. I have 2 more slides about the RD 538 program. In the interest of time, to leave more time for questions, I won't go into them. I just want to say that I've worked quite a bit on RD 538 loans with tax credits on our deals with my colleague Bob Morton at Bellwether Enterprise, and I find them to be a very valuable tool to make rural deals more feasible. The loan proceeds are greater than what you can often get elsewhere. I think the advantages of having a very long-term loan at these cycle low interest rates has great value for folks doing rural deals, and so I'd encourage everybody to approach these deals and look at the 538 program as they proceed. Thank you very much.
All right.
Thank
Philip.
you so much, Philip. Thank you. Edgar, there is a question that's sitting here waiting for you, and the question is, can a CDFI become approved lenders eligible to participate in the 538 Guaranty program?
Yeah, I believe so. The answer is yes. We'd have to look at how they're made up, but the short answer is yes.
Okay, let's see. There are no questions in the queue, so folks, if you are out there thinking of questions, having them percolate around, please go ahead and enter them into the Q&A box.
Okay, Sean Terry, I have one question to Philip. And Philip, with the potential of the opportunity zones and the potential of some of the equity that could be brought in, do you see or have you heard anything on whether that will enhance the value of the tax credits should they be used, in conjunction with each other, or do you see where these are going to be separate forms of equity being brought into these projects?
I think the jury's out how much value there will be that will be generated for tax credit investments.
Okay. And just a comment. Go ahead.
The key issue, and I hear a lot more of the drumbeat around opportunity zones in the most expensive to build markets, the coastal markets where the government's eager to provide less soft debt and hoping the equity market will do more for the deals. But those coastal markets traditionally are driven by bank demand, not insurance company demand. So, because banks, we don't anticipate being able to benefit from these opportunity zone investments, the opportunity zones are not going to be additive. I think it may work differently in the rural markets where more often insurance companies are the investors in the tax credit deals.
Right.
And so it could have an additive benefit for rural deals, provided market makers can make the connection between the investors and the right deals fast enough to generate the value the program promises. Okay,
perfect. And with, you mentioned that there was a 12% increase in for the tax credit program that we have the ability to use and are using. Do we see that as bringing more projects to the market, or do we see that as bringing more tax credits per project?
I think from what I've seen, states are trying to get an extra deal or two done, or 3 or 4, depending on what's going on, how big a program they're running. So I think that just in the last few weeks, I'm seeing a little bit of a surge in pricing where competition is rising. So I think that will have state allocators hold out hope that the market will perform better. They can apply the tax credits more thinly over a few more deals than they might have otherwise expected. And so I think deal count is what they're looking to increase.
Do we have any more questions, Shantaria?
We do have a question. Shelley wants to know, is the $6,500 per unit rehab required for rate modification?
No, it is not.
Thank you. Right now, there are no additional questions in the queue.
Okay, so I just wanted to make one point. One of the reasons why we asked Philip to join us with the tax credit presentation is that much of what we do with the Section 538 program is leverage deals, and so even though it's not required, it's important for us to know how these deals come together. And from a program perspective, the 538 does not add a layer of underwriting, and I just wanted to make a comment that we do not add a layer of underwriting when it comes to looking at these tax credit deals, whether it be an opportunity zone transaction or whether it be a tax credit transaction. That underwriting is done before it gets to us, and so we look at the flow of tax credit equity as just that, as equity contribution to the deal. And so when the loans are being processed at the state level, it is being looked at as part of the equity, as part of the sources in the transaction. We do not get into the tax credit calculations of basis and whether what's eligible and not eligible. And so just wanted to clarify that. Sometimes we get questions of whether there is an additional layer or overlays of underwriting when we have transactions that come into the agency with different sources. We do not. So we don't have an additional subsidy layer in review, and we don't have any overlays that we do in the way of underwriting on that. That's it, Shantaria.
Okay, we've had a few questions come in.
Okay.
Let's see, Mindy would like to know, and I'm trying to scroll to Mindy's question. We know that rural homelessness occurs at the same proportions as urban and suburban homelessness. Are there ways that these USDA programs can go beyond income levels to be targeted to developments that would serve a certain percentage of people experiencing homelessness or other barriers to stability?
Well, what we find is that in the communities that we serve at the 115% of area median income, that is close to market rate in many areas, with exception of some of our high-cost areas, some high-cost states like New York, California, Alaska, and many of our West Coast states are high-cost. Currently, that's where we're set up. That moving forward, those are areas where the agency is examining that. As we're seeing more and more transactions that come our way in the way of special needs and homelessness. Currently, the 115% of area median income is our capacity, and that's really our ability. We haven't seen much in the way of a demand for exceeding that when we're addressing homelessness, because most of the homelessness are either underwritten in some form of a master lease or they're underwritten with SSI. And so if I understand the question correctly, we have not seen a demand to exceed what our current program guidelines are offering. But if it is something that we see that is a demand, that is something that the agency definitely will examine.
Great, thank you. Any additional questions out there from the field? We've got another minute or maybe 30 seconds left here on the call. All right, having seen no additional questions come through, Edgar, Philip, do you have any final closing statements you'd like to make?
Philip, anything?
Well, no, I just appreciate everybody, paying attention to our perspective today, and I'll just invite anybody who would like to follow up to email me or give me a call. The final slide on my slide deck shows my information. Thank you.
Okay, and I second that. Any questions or any scenario questions, feel free to email me directly, and I can get back to you with an email response, so you have something in writing there. Anytime you have a question about this program or any other programs, feel free to reach out. We look forward to seeing you guys next week or hearing from you guys next week if that's available for you. Thank you.
All right, thank you guys very much. So before we close today, I'd like to thank our two presenters, Edgar Morales and Philip Porter, and also a very special thank you to Administrator Baxley for joining our call today. As a reminder, please join us for part 2 for those of you that participated today but have not yet had an opportunity to register. You might have noticed that the event is full. However, because of your participation today, we have opened up an additional 30 slots. So immediately following the webinar today, please go to HAC's website, register for part 2. And I'd like to thank you for your time today on the call and wish you a very rest of your day. Thank you.